are getting ready for the jobs report. Ahead of that, we want to welcome a special guest. Glenn Hutchins is North Island's co-founder and chairman, longtime friend of the show. Glenn, it's great to have you here this morning. You wear a lot of different hats, and we're going to ask you about a lot of different topics, but maybe we should start with the jobs report. Numbers on terms of what we're anticipating. It's going to be the first clean jobs report we get since before the government shutdown. And we're just trying to get a feel for the economy. Where do you think things stand right now from all of the inputs you receive?
That's an interesting, it's a good question, Becky. But first, as I was suggesting earlier, I want to congratulate you on your Cures initiative.
Thank you.
I'm very proud of you. It's an important thing you're doing, and you have all of our support.
Thank you very much, Glenn. I appreciate it.
So from the jobs report, you've had other people on the show who've talked about kind of what exact number they're looking for and how the numbers have changed based upon immigration policy and all those sort of things. So as I've thought about it, the question people ask me a lot, and I've seen a lot of writing about it, is this conundrum between weak employment market performance, either job creation or unemployment, strong GDP growth, and companies reporting they're not extracting much value yet from their AI investments. So how pre-AI investments do we have this economy that is having this weak job performance? And as I've gone out and looked at companies, I think it's a pretty straightforward, something pretty straightforward is happening. Company after company are right now extracting value in the form of efficiencies from the last 10 years of investing in things like the cloud, big data, and machine learning. These companies are also very disproportionately being run by a next generation of leaders who are digital natives and tech savvy. So rather than the resistance to characterize the adoption of technology in the past, they're now embracing it and using it. So you're seeing them extracting huge amounts of value from pre-AI investing.
That's pretty interesting, the idea that they are getting more for what they could stretch those resources from before. Where do you think that leaves us in terms of efficiency of what's to come from
that's
AI
that's the important question. So the same young group of executives are, as opposed to the prior cohort that resisted and dragged your feet around investing in the cloud, for instance, are moving very aggressively to invest in AI. AI will, of course, have the same J curve. Right. You'll have to make a bunch of investments, you'll have to hire a bunch of people. But because of this aggressive and early investment, I would expect it to explode in a way that we haven't seen before from the last waves of investing.
And all the efficiency numbers that we've gotten, like yesterday's numbers, you think that that's just all pre-AI?
That's largely an artifact of pre-AI investing.
That kind of opens up the possibilities.
With one exception, which is the massive investment that's happening right now in the data centers. That's obviously roaring through the economy.
Which you, by the way, are the independent director, independent lead director.
But that's less about efficiencies and more about just construction, and a supply chain of goods to populate those data centers.
So what does that efficiency mean long term? Great things for the bottom lines for companies. What does it mean for the jobs outlook?
I think it's a pretty interesting set of questions. If I was thinking about, you were talking about earlier, I think, about the next Fed chair and kind of who that might be.
Yeah.
And there's all these jokes about 50% chance his first name's going to be Kevin.
I think it's quite a bit higher than that, actually.
Higher than that. But I think the more interesting question I've been thinking about is what kind of job that person's going to have. Right. Because they're going to have an enormously difficult task in front of them. Jay Powell is sort of getting out at the right time here. The 20 largest countries in the world are generating, on average, 6% of GDP in terms of deficits today. They start this with 100% of GDP in terms of debt and spending, which is and on debt levels, which is nearly 3 times the level of their government spending. That's completely unsustainable, right?
We've been saying it's unsustainable forever, and yet, for whatever reason, the bond markets have yet to
I get it. Well,
scream.
Okay, but you're starting to see, you've been talking this week about gold and silver and these things. We'll come back to that in a minute. The next Fed chair is going to be under next Fed chairs around the world, because it's not just the United States. The biggest offenders are Brazil, United States, Brazil, China, and one other country. with Japan not far behind, and India not far behind. They're going to come under huge pressure to keep interest rates down in order to facilitate the raising of all this debt and to inflate away the debt. That is obviously at significant odds with the whole affordability problem we have right now, but it's also in particular if even independent central banks try to increase interest rates into that massive flood of financing, they're going to have a very, very hard time doing that without stimulating triggering some sort of financial crisis, which will then cause them to go the other direction in terms of dropping rates, taking all the emergency measures we've seen.
Glenn, if we grew way above what we thought we could,
good question.
If we did that and AI allows inflation to stay relatively muted, that allows rates to stay low.
That's a really good question. So
wouldn't that be great, though?
It would be great. Look, but here's the problem. AI productivity, everybody's going to say AI productivity will bail us out of this.
Right.
We'll be able to grow more rapidly.
That's essentially.
But the problem is that probably only by making the unemployment problem worse, which is why I started at the beginning when you asked me about jobs and unemployment.
Making the unemployment problem worse because we don't
the way it bailed us out is by using many fewer productivity is many fewer people to do these things.
That's a unique set of circumstances.
Right, so that's how to think about it.
But can I ask you a question about the unemployment situation? How bad? I mean, do you say 10% unemployment in the country if AI is as successful as it needs to be for these companies effectively to grow into their valuations that even exist today? Unemployment in your mind is what?
Yeah, it is higher than it is today, and underemployment could be significant. I think the social distress that comes from people being underemployed and unemployed will grow. The kinds of pressure. So my view is over the course of the last 20 or 30 years, the loss of manufacturing jobs and the loss of wages in middle-class jobs have been much more about technology than they've been about trade. And I can quote you a bunch of numbers on that if you'd like. But and this is going to exacerbate that. Right? To go back to the Fed question and then maybe the markets here is that the Fed does not have tools to address structural unemployment.
Right.
And if the fiscal authorities have been spending huge amounts of money, this 6% of GDP deficits continues ad infinitum, they'll be out of money. It's called policy space to address it. They'd have to raise more money to try to address this employment.
So are you calling for much
problem. So they're kind of caught. This is the new Fed chair coming in thinking, oh my God, this is called financial dominance. A term you're going to hear now in the future, in the coming months, I predict it's going to be this concept of financial dominance, which is fiscal dominance, which is the fisc takes over and drives monetary policy in ways and economic policy in ways that the central banks are going to have a hard time resisting. So what do investors do? They buy gold, they buy silver, they buy Bitcoin, they buy tips. They hedge their bets. Again, they go into U.S. equities but hedge their bets to the dollar. They try to get as far away from anything that has to do with the fiscal authorities, particularly the United States, but also Great Britain, France, China, Japan, Brazil, et cetera. Biggest economies in the world. That's the task facing this person who's coming in as Fed chair, and it's one I don't envy them for.